What if I told you the biggest financial decision of your life is not about stocks, crypto, or even your career? It's about your mortgage. Imagine standing at a crossroads. One path leads you to the freedom of being debt-free as soon as possible, and the other path lets your money work for you in the markets. Which would you choose? Today, we are diving into one of the most hotly debated questions in personal finance. Should you pay off your mortgage early, or should you invest instead? And here's the twist. Both choices can make you rich, but one could leave you with nearly $1 million more by the time you retire. Stay with me, because by the end of this video, you'll know exactly which strategy works best for you. To settle this debate, let's walk through a simple but powerful case study. Meet debt-free John and Adam. Both are 30 years old. Both have a $500,000 mortgage with a 30-year fixed rate at 5.3%. Both are disciplined, motivated, and serious about building wealth. Their monthly mortgage payment is $2,768. But here is where their paths split. John is laser-focused on paying off his mortgage. Every month, he throws an extra $1,000 toward the loan. That means he is paying $3,768 monthly. His logic? Once my mortgage is gone, I'll finally have the freedom to invest. Adam thinks differently. Instead of putting that $1,000 into his mortgage, he invests it in the stock market, every single month, while sticking to the standard mortgage payment. He believes compounding growth is his secret weapon. Now the question is, after 30 years, who comes out ahead? Let's start with John. Thanks to his aggressive payoff strategy, John becomes mortgage-free in just 16.5 years, not 30. Imagine that sense of freedom. No monthly payment, no bank hanging over your head. For many people, that's the dream. Once he is mortgage-free, John finally begins investing $3,768 a month for the remaining 13 years. That effort builds him a solid $1 million investment portfolio, plus a fully paid-off home. Not bad at all. But then we look at Adam. He did not sprint to pay off his mortgage early. Instead, he invested that extra $1,000 every month from the very beginning. Over 30 years, his money compounded at an average of 9%. And by the end, Adam has a fully paid-off home too, but his portfolio is worth $1.8 million. That's an $800,000 difference. Same mortgage. Same discipline. Just two different strategies. The real lesson here is simple. Time is the most valuable currency you have. John poured money into his mortgage first, and while that feels safe, he lost the first 16 years of potential market growth. Adam, on the other hand, let time and compounding do the heavy lifting. Think of compounding as planting seeds. The earlier you plant, the bigger the forest you shall grow. Every year you wait, you are losing exponential growth. And here's the kicker. If interest rates were lower, like the 2.75% or 3% mortgages many people had just a few years ago, the gap would be even wider. Adam could have ended up over $1 million richer than John. Now, let's be honest. Numbers don't tell the full story. Personal finance is called personal for a reason. Not everyone has the discipline to invest consistently. Some people need the psychological relief of paying down debt. And that's valid. For many Americans, debt feels like a weight on their shoulders. Paying it off brings peace of mind, reduces risk, and creates a sense of freedom. If you are someone who sleeps better at night knowing you don't owe the bank a dime, paying off your mortgage early might be worth more to you than an extra $800,000 on a spreadsheet. But if you are a financial mutant, someone who maximizes every opportunity, invests consistently, and knows how to control spending, then letting your money grow while carrying a low-interest mortgage can be the smarter play. So, are there times when paying off your mortgage early actually makes sense? Absolutely. If you are in your 50s or 60s, and you have already built a solid nest egg, paying off your mortgage can be a great way to de-risk. At that stage, wealth growth is not your only priority. Preserving it matters just as much. Being mortgage-free in retirement can give you peace of mind and lower your monthly expenses dramatically. And here's a personal story. Even seasoned financial experts wrestle with this. One of them admitted that despite having the money to pay off his mortgage, he held back for years because his interest rate was only 2.5%. Why rush to pay it off when his cash was earning close to 5% elsewhere? Eventually, he decided to pay off the last $43,000 of his mortgage. Not because it made financial sense, but because it simplified his life. Sometimes, simplicity is worth the price. At the end of the day, debt is a tool. It's neither inherently good nor bad. It depends how you use it. Some gurus will tell you that all debt is evil and you should avoid it at all costs. Others will claim debt is the secret to wealth, leveraging everything you can. The truth lies in the middle. Smart investors know how to balance the math with the mindset. They know how to take advantage of low-interest debt while still building wealth aggressively. And they know when to step back and de-risk by paying things off. So here's the million-dollar question for you. Are you more like debt-free John, chasing the peace of mind of no debt? Or are you like Adam, maximizing your money's growth through investing? There is no universal right answer. The best choice depends on your age, your goals, your interest rate, and, most importantly, your mindset. But remember this. Every year you wait to invest, you are losing the most powerful wealth-building tool you will ever have, time. If you want to learn more strategies that help you maximize your money and avoid costly mistakes, make sure you hit that subscribe button. And drop a comment below.